Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is Thursday, May 11th, 2023. We got a great interview coming up. Michael Gayed. He is the lead editor of the Lead Lag Report. You also may know him from social media. Over 740,000 loyal followers on Twitter. The guy has been on. He's been talking about everything from lumber to gold to the US dollar and what he believes is a pullback coming in stocks. We'll debate that and much more coming up right now on Making Money. One of the most notorious months in investing calendar has arrived with a bang. You've likely heard the expression, sell in May and go away. And after all that's happened this week, you may be tempted to act on that. But I can almost guarantee you've never heard of this earth-shattering Wall Street event headed straight for US stocks in less than 60 days. Now, the date is all set. It's coming. 63 funds are actively preparing to send shockwaves for over $10 trillion of American wealth. And you have mere weeks to get ready before a wave of volatility crashes over half of the US stock market. My good friend and brilliant forensic accountant Joel Littman stepping forward to help you protect yourself. If you have money in IRAs, 401ks, annuities, pension plans, stocks, or bonds, I urge you to give Joel's warning your most serious consideration. It couldn't be more important. Protect your wealth in the weeks ahead. Head to 2023selloff.com now to get his updates. Again, that's 2023selloff.com. Do not miss this. All right, so here he is, Michael Gayed. Michael, thanks so much for making your first appearance here in Making Money. I know you've been on a couple of other colleague shows, and I've watched them all. So follow you on Twitter. Very active on there. So I want to thank you for all the stuff you do for the industry and taking some time to join the show.
I am sorry that you follow me on Twitter for whatever it's worth.
It's kind of a full-time job almost following you on there. You have a lot of comments on there and it's all over the place. But one topic we're going to get to, because I see this a lot on your posts, is lumber. So we're going to get to that, but we're going to wait a minute to jump into that. I'd like to ask you kind of just more of a big picture right now. You know, what is your view where we are in the market right now going forward? Obviously, we have the Fed potentially pausing. We have inflation that's come down several months in a row. The employment market's still hot. Where are you viewing the market going from here heading into the summer?
Well, I think we have to define what the market is, right? Because This has been an unusual year in a lot of ways in that you've had a dramatic differential between large cap and small cap. Right, largely because of the regional bank co-movement. You've had a dramatic differential between growth and value from a style perspective, right? If you look at a lot of stocks underneath the surface, a lot of stocks seem to be in a full-on correction, while the headline averages, which are large cap oriented, right, are not really sort of suggesting there's that much trouble, at least not yet. So, yeah, I think where we are is I've been very loud about this idea that I think the third week of April may have been the start of a stock market correction based on a lot of intermarket analysis that I do, more than just sort of volatility as a risk-off play, but that directionally we could maybe see a revisit of the October lows, which for those that are wondering why on Twitter I say October, it's because I think we maybe see some kind of revisit of the October lows. There's a lot more damage, I think, than people realize that's happening beneath the surface. You've got very narrow leadership. Again, going back to small versus large, it's been largely tech-driven. Beneath the surface, lumber keeps on weakening. Utilities look like they're holding. You've got this debt ceiling showdown, which is a lot of theater, but fires sometimes happen in theaters, right? And in general, I think there's just very short-term a lot of complacency. Now, that's a short-term argument. Right, I keep going back to we're in a pre-election year. Pre-election years are historically among the strongest in the stock market, which makes it more of a melt-up type of environment, but a volatile one. So short-term, probably high risk. I don't think you're in a crash type of scenario. I do think there's going to be something down the line that's going to spook the markets. Maybe it's going to be something from the regional bank side that suddenly comes out of nowhere, or it could be something else really nobody sees coming, but typically, this was what markets do. They tend to surprise the consensus. The consensus seems to be that this regional bank crisis is isolated. The consensus seems to be that we're still in a very smooth up move, and that is not going to be any volatility because the Fed's done hiking, I tend to pay attention when the consensus is loudest.
Yeah, I do too. I'm a contrarian investor by trade. So, I tend to do the opposite of what the masses are doing. You make a great point of the headline numbers. Heading into Tuesday, we the NASDAQ 100 year to date up 11.5%, closed Monday at what they call the end of the bear market. It's up over 20% from the December 28th low. Meanwhile, you have the S&P 500 only up 2.6% in that time frame. And you have the S&P small cap down 2%. So you can see, that's a major difference in what? 4 months and change. I mean, that's not a long amount of time to have such a difference. So I agree with you 100% on that. So do you believe this breakout, let's call it, if you will, of the NASDAQ composite that broke out to a new bull market over 20% from that low, that is something that's short-lived, that we will see that start rolling over here in the near term?
Well, I mean, first of all, by the way, all those dynamics make it maddening for asset allocators, right? Because you're not getting sort of the rising tide lifting all boats or sinking all boats. I mean, there's a lot of weird co-movements that are happening. But the NASDAQ made new highs, but not in real terms. Right? I mean, after inflation, we're not at new highs on the NASDAQ. Could be a false move. I mean, gold's also at that kind of point in time. Right? It's interesting, right? You've got gold kind of hovering around the highs, just like the NASDAQ. Two very different types of asset classes, stocks and commodities. So maybe I do think that a lot of this narrow leadership is because there's a tremendous amount of hype around AI. I really do think that this is sort of what is keeping the mega cap, large cap tech, which are at the forefront of AI, elevated. Right now, whether it's justified or not, nobody knows. Okay, but there's a disconnect in the narrative there, right? Because if the bet is that these large cap tech companies are going to benefit from AI, as the companies that are pushing it out and getting all the profit from that, well, I thought AI was supposed to help the productivity of every other company, which is performing kind of poorly. So I don't know. I think it's a very tricky thing to sort of justify why there's such narrow leadership at this point, other than to say, typically prior to major declines, that's what you tend to see.
The narrow leadership is what you're saying. Typically before declines, you'll see that narrow leadership. Okay. Yeah, 100%. I believe that. You talked about, a lot of people talking about, that things are okay. And you turn on CNBC or Fox Business, wherever it might be, Bloomberg, typically it's going to lean, at least right now in my mind. I try not to turn the media on. I was in the media for over 10 years. I think it's complete garbage. I think, it's on mute usually to make sure anything bad happens. I know what's going on in the world. But I mute the hell out of that stuff because they annoy me, because it's the same jargon every day. And as bullish as they have been as of late, because they just ride the trend that we're in, and that's up right now for a lot of the indices. You look at some of the other indicators, Michael, such as B of A looking at institutions sitting on the largest net short position, sitting on the most cash. Obviously, money markets brought a lot of money in out of the banks, sitting on several $1 trillion. Does that give you any indication that, well, maybe with all that money on the sideline and some big money thinking we're going to have a hard landing, let's call it for lack of better term, that may limit the bottom on the downside?
Yeah, and I think there's a lot of people that will argue that. I don't necessarily disagree that much. What I would say is that cash has a funny way of being evaporated under margin calls, and we're in a very leveraged system. So, the speculative positioning is interesting because you can say that not just when it comes to stocks, but treasuries too. I mean, treasuries also have, on the long duration side, a tremendous amount of speculative large players that are shorting price, betting on higher yields still on the long end. I don't know. I often wonder how predictive a lot of this stuff tends to be. I mean, I've seen some evidence that it suggests that these are sort of contrarian signals, but the thing is, if it's a contrarian signal, everybody knows it's contrarian, then you want to be contrarian on being contrarian, meaning the shorts could be right on this, right? So it's it's going to play the second and third iteration on that. But, do I think there's limited downside? It depends on what housing does.
Yeah. So let's go to your lumber. Obviously lumber, the price of the lumber futures has gotten smoked since what was a high, March of 2022, maybe somewhere around there. Since that time frame. What I find fascinating about that is we're taping this on Tuesday. The ITB, which is the housing ETF, is breaking out to a 15-month high. So it's basically done the exact almost opposite in that time frame, not day for day, week for week. But how do you explain that? Like, how do you explain that the lumber is going down, yet there's still this demand for housing and prices aren't kind of going with each other?
Yeah, a lot of people have been noting that, and I've noted that too. The thing is, first of all, we have to take a step back. Personally, I have not seen any evidence on this. I'm happy to be proven wrong. So if anybody can prove this to me, I'm happy to talk about it loudly. But I have not seen any evidence that suggests that home builder stocks are predictive of housing, meaning the outperformance, the spread differential. I agree with you. It doesn't make sense, right? So you've got lumber, which is a key commodity when it comes to home construction, new homes. And you've got home builder stocks acting like, you're in another bull market for housing. I know the evidence is there for lumber. I don't know if the evidence is there for housing stocks. So that's kind of number one. Number two, I get all the inventory arguments, right? Like I get this idea that there's no inventory. Everybody's stuck in their house. Nobody wants to let go of their 2%, 3% mortgage rate. So it's just going to be a very constrained market for a while. My problem with that argument is that people seemingly forgot that a lot of that shortage of inventory relates directly to the movement towards Airbnb and turning properties into income generating assets, right? So it's like I've seen these stats, that say that there's 3 million homes that are short that need to be built. Okay, but there's 10 million second homes and third homes. So, and a lot of this, because again, this Airbnb type of move was zero interest rate policy for the last decade. So my point is that you can get a tremendous amount of inventory very quickly if just a few marginal sellers panic sell, right? And if that's the case against housing construction, which does not look like it wants to pick up because that's what the message of lumber is telling us, at least for now, all that to me sounds like a recipe for a surprise to be contrarian on housing on the downside, right? Because everyone still seems to think that inventory is what saves it. Again, I could be wrong, right? But it is a notable disconnect. I would rather place my bet that lumber is right than home builder stocks until somebody can prove to me that home builder stocks have predictive power. Gotcha.
Yeah, I mean, it's an area that I can be persuaded each way, Michael. Honestly, I had a guest on last week, very bullish on home builder stocks, and he made a great case. Your lumber case is a great case on the other side. I don't know. I don't have a crystal ball, but I could see both playing out honestly and not be overly surprised if either of those scenarios plays out going forward.
And I will say real quick, I think I don't know either. It's like, it's like, everyone, again, everyone listens to, and watches shows like this because they're hopeful that somebody can predict what tomorrow brings. But, I always go back to about conditions. And I do think there's a lot of people that will reference things related to housing that just when you actually test it doesn't really matter in terms of future price movement. Lumber, at least there's some cause and effect there. So listen, I tweeted this out. I put it actually on Instagram a little bit earlier today. Even I've been surprised at how much lumber doesn't want to get off the ground, like at all. Entering, what is supposed to be a period of good construction, right, with the home building in the spring and summer periods. So we'll see, right? But logic to me would dictate that the complacency around housing being a big driver of credit contraction, not just commercial real estate, right, which everyone's focused on, but housing in particular, that could surprise the markets down the road. Speaking of commercial real estate, had a discussion with a lot of different people, and again, a lot of different views on it. Some people will say it is really the next big shoe to drop. That's going to be what's going to really take the market down. Then you have people on the other side saying, "Well, shit, everybody's talking about that already." I mean, this isn't something that's not known. We've been talking about this for years. We had an analyst meeting with all of our analysts a couple of weeks ago, and one of them made a pretty good point that the tier 1 are fine. The tier 2 to tier 3 regions, those CREs are going to get crushed. Yep. So, it's more of a regional thing. Do you think that could be something that is a catalyst to bring this market down, whether it be the housing or overall the stock market itself, kind of drifting into credit issues? Well, I put that tweet out before. It's regional until it's systemic, right? It's like, it always is something until it's not, right? So I do these Twitter spaces, right? And I turn them into my own podcast under Lead Like Live. I had Dan McNamara on, and, his focus is on commercial real estate. And I asked him that very question you just posed to me, which is that, everyone's talking about this, especially on the office side, right? It's like, shouldn't the market have already discounted a lot of this? And his response was yes. I think where there's going to be a question mark is, it's not like a bulleted rollover of refinancing in commercial real estate. To your point, it's regional and it's at different maturities. The question is, if you end up having some real sort of rollover crisis with regional banks, which are pushing a lot of commercial real estate loans historically, and suddenly no longer lending at the time of the rollover. And that's the question mark. So yes, I'm with you. I think it's a risk. I think it's challenging to kind of figure out the timing of how that risk manifests, but because it's not sort of bulleted and more like a rolling crisis, all that probably means is that it's just going to cause a kind of nasty headwind for some time for risk on assets.
Yeah, I agree with that. Yeah, trying to time this is just crazy to me because again, we could be talking about this 2 years from now and be the same situation and nothing's really happened.
Right.
You mentioned early on, Michael, small caps, large caps. Obviously, small caps we mentioned have greatly underperformed here for probably the last 18, 24 months. And historically, they do better than large caps over time. Do you see any opportunity in the small cap space? Or do you think this is something that's an indicator that the large caps are going to draw down to meet them?
I mean, at some point. So first of all, the usually when lumber is weak, small caps are weak, because if lumber is about housing, it's about consumer wealth. If it's about consumer wealth, then you would expect small caps, which are more sensitive to domestic consumers, to also be weak. So there's actually a consistency, right, in terms of the link between lumber's weakness and small cap underperformance. I note, by the way, that you look at consumer discretionary sector ETFs or stocks against the broader S&P underperforming, pretty meaningfully. Retailers against the S&P underperforming pretty meaningfully. I mentioned that because underneath the surface, bets are that the consumer is going to be weak, right? Which, again, it would be consistent with lumber, housing, inventory suddenly coming back on because consumers start realizing I'm out of cash. Mm-hmm. I think that's what the market itself is suggesting. Now, is there going to be opportunity in small caps? Sure. The challenge with small caps is, as you know, you do have a lot of these zombie companies, right? So it's not quite, there's a parallel to the commercial real estate argument where it's like a lot of these companies got to roll over. They're not going to all roll over at the same time. Who knows if they're going to survive or not on higher interest expense. But it is not a sign of a healthy market, I'm going to argue, to have small caps not participate at all, right, in this. Again, combined with consumer message and lumber. So for a trade, sure. At some point, there's going to get so bombed out on a relative basis, they're due for a run. For a long-term buy and hold, I don't know. I'm the first one to say nobody can predict the very long term, but I happen to be of the mindset that the next decade are probably going to be very challenging for U.S. equities in general, which means small caps will probably get hurt even more over time.
All right. So going back to your lumber one more time, I don't want to beat this too much, but if you were to see the chart of lumber start to build that base and turn its way back up, it sounds to me, and I don't want to put words in your mouth, would that be something that kind of clicks in your strategy and say, okay, well, maybe that's going to lead to a lot of other good things that will trickle down to small caps and the rest of the market. Is that true, or am I just making it too simple?
No, it could. I mean, so depends on how long it lasts for, right? So you've got a lot of lumber weakness. This is the thing. It's like lumber leads, meaning if lumber is right about housing, even if lumber were to pick up, you would start to see the leading coming into the coincident. That means now, meaning the current data has to reflect the prior weakness, even if the lumber going forward side sort of improves. And I did a Twitter space with Stinson Dean. He was a lumber trader. He made it a point that, typically lumber leads the housing market by 4 or 5 months. Now, in this case, lumber's been weak for a while, but it's kind of still around new lows. So I don't know. We'll see. I know a lot of people focus on lumber because that's, what I often talk about a lot on Twitter. But there's a lot of confirming things besides lumber: utilities, defensive sectors, small cap weakness, consumer stocks. There's a lot of intermarket things that play that even if lumber were to have a rebound, you'd want to see it being confirmed by other consumer, sensitive areas. I don't see how that's going to happen just yet.
What about copper? Do you follow copper at all? Because obviously that's pretty important as far as the global economy is concerned. China has been attempting to reopen little by little, and you see their numbers ticking up. Obviously, you don't know if you trust all those, but how do you see copper acting now and potentially as a leading indicator in the future?
Yeah, I mean, a lot of people reference in quotes Dr. Copper. I mean, there's some predictive power there. It's not as strong as lumber. But I think broadly, in general, commodities seem to be rolling over across the board. I mean, maybe I'm wrong on that, but that would be another sort of, I think, warning sign conceivably. Right? And by the way, this shouldn't be a surprise to anybody. This is what higher rates do. I mean, this is the whole point of this, right? It's
what the Fed's been trying to do, right? This is what the Fed's been trying to do. Yeah.
Right. I mean, and look, you probably saw the and I haven't tracked that closely, but the German industrial production or manufacturing production, whatever it was, was a surprise negative number. So you are seeing big manufacturing entities outside the U.S. at least start to have slowdowns and weakness, right? So that should filter through to the commodities. So I don't think that's a surprise. It's always a question of magnitude with this stuff, right? So people can get the direction right, but you have to tell me the depth, right, of the decline, and nobody really knows. But again, I go back to when you have so much leverage in the system, it's easy to have tail events. So
you mentioned before, and I meant to ask you this earlier, is just kind of looking at the consumer side, that retail stocks, discretionary sector, just the eye test. I don't go out that often, but I'm on a plane probably once a week on average this year. I'll be on a plane again Thursday, heading down to Nicaragua. But I'll be in Miami airport, you look around, and it's just every plane I'm on is packed. The airports, I can't get a bar stool if I want to get a quick drink before I board. The prices are insane. If I want something that's outside of water, like an energy drink or something, it's like $8, but people are paying it. So I look at that, and I live in South Florida. I go outside, and restaurants are mobbed. Like the eye test tells me things look pretty damn good, but then you look at other numbers that we look to in our industry, and it doesn't tell the same story. What am I missing here?
I think you're missing that people are dumbasses.
I know that. Don't worry, I know that.
No. I mean, this is like. Look, let's face it. COVID, I think, made people realize, rightly or wrongly, that life is fragile and that you don't know if tomorrow is going to come for you. So you spend now because you don't know if you're going to live tomorrow. I mean, that was really where the inflation impulse came from. It was psychological more than just the money, right? I mean, more than just the stimulus. It was the idea that, well, if not only is the money coming, but shit, I might die tomorrow, so let me go out and spend. So my point in referencing that is, I still think there's some tail persistence of that. There's some ongoing sort of crowd sentiment outside of our industry, which tends to be, I think, more negative. I'd argue maybe rightly so because of link of rates to markets. But consumers are not leading indicators, right? I mean, I often wonder how people think when it suddenly they are spending, to your point, these crazy numbers while their credit cards are going to 30-35% interest rate. I mean, I don't know. I think a lot of these people are going to get shocked and surprised when at some point that lag of interest rate policy comes to the here and now. Yeah.
Yeah, the dumbass comment's probably the one thing I agree with out of any guest I've ever had on. I do agree with that, and I'll tell you, I'm one of them a lot of times. So I'm not pointing fingers. I will. We're
all dumbasses. It's like
So speaking about spending dollars, what's your view on a greenback? Obviously, it had a hell of a run last year. It's come down in the last 6 or 7 months. It's kind of been basing here recently. Do you have a view on a greenback, Michael?
Yeah, I mean, well, first of all, when it was going vertical, I was one of the few people on Twitter that was saying, I was putting out the, I think it was the InSync buy Giphy saying, in terms of just the dollar wrecking ball. It was so everywhere on all the magazine covers. It was the classic contrarian trade, right? When it peaked. But having said that, now the sentiment's gone the other way. It's funny how that works. Price has a funny way of changing people's conclusions, right, about what happens next. Look, if you have a risk-off period, if you have a high volatility period, if you have a correction, historically, the dollar tends to benefit, right? Alongside gold, alongside treasuries, alongside utilities. Last year was, the dollar was the clear beneficiary. Treasuries were the abysmal failure, right? Which is unfortunately what hit my rules-based funds, ATAC, Troro, and JoJo, because they rely on treasuries as the safe haven. But I suspect that if you're going to have any high volatility, you're still going to see that flight to safety dynamic. Europe is still a much, much worse part of the world than the U.S., right? So, and they can't really raise rates much further, and they need to. All right. So, if anybody thinks the regional bank crisis, which is largely because of a delayed response to the duration sell-off in the U.S., is not going to filter through to Europe outside of their own banks, outside of what we saw at Credit Suisse, I think you have another thing coming. The lags are going to be even worse in Europe because it's not as cohesive as the U.S. So just from a relative currency perspective, and given that the euro is obviously a big component of the dollar index, I suspect the dollar probably is going to actually have its own move back up. And I'll tell you just anecdotally, there's so many people that are talking about de-dollarization as if it's going to happen tomorrow. This stuff takes time.
I will tell you, you're probably like me. You go places, you have speeches, and you always get that one question. I always get the guy, and this has been for 20 years. This isn't just in the last 2 years. For 20 years, you get the guy in the back who's been reading some crazy, propaganda bullshit. And he's like, I heard that they're going to come to next week to and take all of our dollars away, and the dollar is going to be gone. And the Chinese yuan, before it was a euro, it was a Japanese yen. And I always smirk not because I'm trying to be rude to the person, but at some point, will the dollar lose its reserve currency status? 100%. In our lifetime, likely not. Like you said, this stuff doesn't happen overnight. And the easy argument is, which you'll probably agree with me, is what takes its place?
Right.
That's the thing. Who's waiting to take its place?
Right.
And I don't know where that is right now. I mean, I think in transactions, what's the dollar's 70% or something, and what's the yuan? 2.5%?
Yeah. What's missed with all these arguments is that at the core, it's the reserve currency because of the legal system, right? Because of property rights. I mean, this is why it's not going to be yuan. That's why it's not going to be Russia. That's why it's not going to be anything else. And the euro, good luck, right?
Yeah.
Well, especially with what we saw in 2011. So this is what it was. But it's also kind of like silly to me. It's like, all right, so for all the doomsday arguments, are those people learning how to farm? Are they doing anything to enhance their own skills in the event that they are right? Because if the dollar is not the reserve currency, society collapses when you have $32 trillion of government debt, let alone all the unfunded liabilities. So it's like, you don't want to see it happen when your starting point is so weak to begin with. Now, maybe Bitcoin replaces it. I have my doubts, right? Maybe we can get into that for another conversation. Maybe gold replaces it. I have my doubts, right? So it's like, everyone suffers from severe home bias and lack of understanding of just how bad it is outside of our borders. So you mentioned gold. What is your view on gold? I hear the strong dollar argument coming from you, and I think naturally, and I didn't read your view on gold, so this is just making up. You have to be a bit hesitant on gold because you think the dollar is going to be strong, or do you think they can both move up in tandem? No, they can definitely. I mean, they're not as correlated as people think. I mean, that's the first thing. I've long made the argument that gold ends up having momentum when real big allocators believe that the bear market takes a while to play out. Okay, so taking a step back, there are really very few true uncorrelated assets. Gold happens to be one of them. So if big money believes that you're in a lost decade, they want more diversification. Right? If they want more diversification, it doesn't mean having 500 stocks because they're all correlated. Right? It means having something that marches to its own beat, which is, I think, what gold is. I would make the argument that gold's movement is actually suggesting that if it were to continue, right, we'll see, it's probably big money betting on some kind of a lost decade for U.S. stocks. Right? So I think that is probably the driver, right? At the margin, it's reallocation by large players that are saying, you know what, U.S. equities are going to be challenged for a while. We need to have things that are not going to move like U.S. equities. There aren't that many options, right? Treasuries now are an option. The dollar is still elevated, so there might be some room to move higher, but that's more for a trade. So maybe gold is it. Alongside Bitcoin, to some extent. Yeah, I was saying, so you mentioned Bitcoin. What is your view on Bitcoin? I mean, I think it's. I think people forget that volatility works both ways, right? So some people will say, "Oh, gold annualized 50% or whatever the last 3 years." Okay, yeah, but it also gave back all the gains, from 3 years ago at some point in the last 12 months, or whatever the stat was. I'm always hesitant. I use that line many times on Twitter. When an investment becomes a religion, it's time to lose faith. Right? So I'm always hesitant when people are maxi on anything, because you could be right, but tell me when you're going to be right. Right? So in the context of volatility and one's personal risk profile. So I think there is going to be a juncture, very possible, where Bitcoin does diverge from the NASDAQ. That correlation breaks. And the funny thing is, I think that correlation breaks because institutions get out of Bitcoin because of all the things we've seen with the exchanges. It's like the curse for Bitcoin ended up being this institutionalization drive, right? Because the moment Bitcoin became part of an institutional mandate, you and I both know consultants come in, they got to classify Bitcoin as something. Mm-hmm. So they classify it as a risk asset. So then suddenly it starts co-moving with other risk assets like the NASDAQ. So it doesn't diversify, right? It just becomes a lever play on equities. So if you remove that institutional side, I'm going to argue it actually probably breaks the co-movement against U.S. equities, against the NASDAQ in particular. Whenever you have a real risk-off period, if Bitcoin can prove that it can diverge from U.S. stocks on the downside, that's going to be a major moment for Bitcoin. You haven't seen it yet, but that I think is what people should want to see.
Yeah, I agree with you 100%. Especially last year, you think you have your Bitcoin, that's going to be that one asset class that has basically zero correlation to anything. And It was so correlated in NASDAQ. I did see the numbers about 2 weeks ago. Year to date, it has changed a bit. The correlation has dropped dramatically. But I don't judge anything in 4 months. That doesn't make a market. So I need to see a longer time frame for that to come true. And obviously, the regional banking crisis has helped Bitcoin as people get more weary of the traditional, banking industry. Before I let you go, Michael, I ask every guest what I call the island question. And basically, if I took you, your family, your friends, maybe you want to go by yourself, 10 years on an island, what any island you want, you could have one investment. It could be an asset class, stock, it could be a fund, anything you want, something that you feel very comfortable with, parking for 10 years, throwing your phone in the ocean and not looking at it.
So you had a lost decade plus in emerging markets. The best time to buy anything is when you've lost a whole generation to the thing that you're looking at, right? So I think emerging markets are probably it. Now, having said that, I could have said that at any point in time in the last year, 2 years, 3 years, 4 years. So this is why this game of investing is so hard, right? Because all the arguments are there for emerging markets, especially now that you don't have QE, right? At least in the same form, which was the real distorting mechanism that caused momentum to go into U.S. stocks as opposed to emerging markets. That's the funny thing about QE3. The dollar bottomed when quantitative easing 3 and ZIRP took place. The dollar bottomed because there was an unfair advantage from the Fed squashing volatility in risk assets, causing money to flow into the U.S. The dollar milkshake theory has been happening for a while now, right? So now you don't have that. Now you've leveled the playing field. I'm pretty sure that nothing's changed with the demographics on emerging markets. I'm pretty sure that all these emerging market countries are, a lot of their poorest are suddenly now getting, $50, $40 smartphones and now getting access to all kinds of knowledge and information. So I think if you're going to really just say, close your eyes and don't worry about it, what would you rather bet on? The part of the marketplace that had a phenomenal 10 years or the part of the marketplace that had the worst 10 years?
The latter. I've learned the hard way. Yeah, you have to go with the latter. And I love that idea. I mean, I look at the emerging markets and you made a good point there. I thought they were an opportunity a couple of years ago. And really, I'm looking at EM now, just the large ETF, diversified ETF. It's at the same price a couple of years ago where I liked it. So I wouldn't have lost money. I didn't make the move, but it's at the exact same price. It didn't take off yet. But again, I'm a long-term investor at heart, Michael. So 10 years for me is fine. I'd be okay buying EEM or something of that extent here, some type of low-cost, diversified investment vehicle with exposure to the entire emerging markets. Sure. I don't want to be overly in China or overly in any area. I want exposure to Asia and Africa and some frontier markets. But I think there is true opportunity there after a lost decade, because it's not as if it's in Japan where the growth is gone. The growth, like you said, is still there. And the education level is getting higher. The middle class is growing. I mean, there's so many, the demographic trends have not changed. If anything, they've gotten stronger in the last 10 years, in my opinion. So,
and ambition has gotten stronger. I mean, ambition is what drives things.
Yeah. Well, awesome. Thank you so much for coming on. I will say I did not look into lumber much until about a year or so ago when I started following you. And now I think I'm a bit of an expert on lumber. I know nothing about it, Michael, but after reading, I feel so much smarter about lumber in real estate. So I want to thank you for everything that you do. Please check him out on Twitter, his funds as well, everything. You do a great job for our community, and please keep it up.
I appreciate it. Thank you very much.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.